The Stock of the Day is brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended trading hours on key US shares and competitive spreads, all on an award-winning platform. Get started at IG.com.
And our stock of the day, or stocks of the day as the case may be, Seven West Media and Southern Cross Media are merging to create a common TV, audio and digital platform under the proposed merger. Seven West will own 49.9% of the combined business. Southern Cross will own 50.1%, between $25 and $30 million expected in annual pre-tax cost synergies, expected through the reduction of corporate overheads, operating expenses and facility utilisation. Seven West Chair Kerry Stokes saying the combined companies will be better able to serve both metropolitan and regional audiences as well as advertisers, and in fact he'll retire. Jeff Howard, the MD and CEO of Seven West, will take the reins of the new company. And Francesco, just taking a look, in fact, not pleasing one of its major shareholders in Southern Cross, being Sandon Capital, saying that this is value destructive. How do you see it?
Yeah, look, I've only had a brief look at it, but you know, if that's one of the large shareholders in Southern Cross, it does need shareholder approval by both parties, so that might be a bit of a sticking point. So if I go through things that are required, they're going to need some ACCC approval as well for cross-media ownership. So that's going to be a bit of a hurdle for them, I think. But when I look at the assets that both organisations have, then you got Seven West Media, which are free-to-air TV, so Channel 7 basically, 7 Plus, and the West Australian newspaper. So they got some sport in there. They got AFL, they got the cricket, obviously other TV programs. They have struggled a bit with profitability, so that might be a bit of an issue with some of the Southern Cross Media shareholders. FY25 net profit of 17 million on a 1.35 billion revenue doesn't give you a great deal of margin, and probably creates a fair bit of risk. When you look at, about 9.2 million in profit for Southern Cross Media on 422 million in revenue, those ratios, Southern Cross is more profitable than Seven West Media. Southern Cross, basically radio broadcasting, Triple M, hit network, not stations that I'm totally familiar with and listen, which is digital audio. Look, I've sort of stayed out of the media side of things for quite some time because there's so much disruption in media at the moment. With so previously we had TV, radio, and newspapers. There's so many different online content these days that it's hard to decipher. We're seeing a lot of, particularly at the retail level, marketing budgets being spent more on digital marketing than the traditional side of marketing, so it's a difficult one to look at. Southern Cross Media, we would say would be the preferred investment. It's got a better balance sheet on it. The digital audio growth, I think there's probably more in that than free-to-air TV. You got a captured audience when most people are in the car or whatever. They tend to either listen to their streaming services or the radio. So you got a captured audience there, whereas TV now, you sit down in the lounge, you flick through the TV and there's nothing on, so I'll go to Netflix, I'll go to all the other streaming services that are out there to watch something that probably don't have advertising in it. So I think the landscape's changed a lot. It makes it difficult. Maybe this is something that they want to sort of package up a lot of different streaming services, but would I say buy Southern Cross or Seven West Media? No, I'd probably avoid the landscape at the moment.
Yep.
I don't think there's a huge amount of value in it.
Mark?
Yeah, I mean, I get why they're doing it. It is an incredibly competitive landscape, and having that end to end, where if you're going to go and sell media or advertising, being able to sell it across multiple platforms as one package, not only reduces cost to the companies wanting to do the spend, but you obviously would get some economies of scale there, and but. Yeah, we've had Disney, Tencent Music and Netflix over the course of this year in US markets. I mean, you look at Nine Entertainment. I don't think they will have anything from a regulatory point of view because Nine Entertainment's essentially got the same model but twice as big. And look what's happened to that share price. And they've had 2 or 3 years to try to get that under control. So it will make some headline differences to the net profit with that 30 mil, but compared to revenue, I mean, what it just shows is the revenue between the two of them is 1.7 billion. I mean, 30 mil makes a big difference to the profit, but their margins are only because their margins are so wafer thin. Yeah. So just that scalability, with the global brands, I think their ability to have media, movie releases and things. It's not a space. I think there's a better global stock exposures to be involved in the space where there's going to be some growth. I think I think they're doing their best. Don't get me wrong, but I mean, if you want to see how the model has generally panned out, have a look at Nine Entertainment's looked cheap for about 5 years, and it just will not go up.
Seven West looks cheap too. So I mean, to that degree, so does Southern Cross. They all look cheap, but they're cheap for a reason. And part of that is, I think, more the disruption.
But I think for the cost-saving benefits and the efficiencies, I think it's the right thing to do. But it's our job to tell people where they buy, hold, and sell, and I wouldn't buy it today.
Doing your best is not necessarily good enough, it would seem then. So I'm taking that as an avoid also.
Yeah, for me, it'd be an avoid. So
that's a double avoid for our stock of the day, 7 West Media and Southern Cross.
The stock of the day was brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. Get started at ig.com.